All right, everybody, welcome back to another episode of Making Moves in Multifamily Live with your favorite hosts, Tim and Tim. You're Tim, I'm Tim, we're Tim and Tim. This week, we're talking about a rather complex subject. It's very relevant with what's going on in today's politics, and we wanted to talk about why you, as a real estate investor, should care about the debt ceiling and potential impacts it could have with inflation. Because we know that the debt ceiling is basically the government borrowing money, right? Tim, you had when we were discussing this before the show, you had a good analogy of using a credit card to pay off a credit card. Taking out debt to pay back debt. That's essentially what's happening when you raise the debt ceiling. As of right now, I believe it's proposed about a week ago. The GOP came out with a revised budget that raises the debt ceiling $4 trillion. Now, it has not been approved as of this point in time, but what does it really mean for you as an investor if the debt ceiling is raised, and how is it going to impact inflation? Tim, you got any immediate gut reactions? I mean, because I chuckled at your credit card to pay off credit card debts because it's relative. Yeah. So I
Yeah,
wanted to hear your thoughts on a high level before we kind of dive into some details.
I got to be honest, guys. Like this is pretty complex. As far as like how they play that game, I'm probably not the guy to talk to. It's pretty. I mean, like I said, it's pretty complex, right? Like raising the debt ceiling so that we can service our debt by using more debt, is essentially what we're talking about. I think from our standpoint, where it really comes into play is taking into account like what that means for inflation, what that means for costs, what that means for, basically the stuff we own, right? Not
Right.
only the stuff we own, but where you might want to go invest your money over the next 12 to
Also
18
true.
months, right?
Also true. So, all right. So if we don't change the debt ceiling, essentially what could happen is the United States as a government could default on its borrowed debt money, right?
Right.
And if you've ever heard of in the insurance world, it's called the AM Best rating. Whether you're like an A plus or A plus plus or an A rating or whatever, it kind of shows your liquidity and your financial stability as an organization, right? Countries have the same level of ratings for their borrowing money, right? I mean, because everybody is a creditor or a debtor, right? You're either lending money or borrowing money.
Yep.
And the United States as a country has a borrower's rating. If we don't increase our debt ceiling, we have the potential of defaulting on our loans. Okay, Tim, what the hell does that mean? So first and foremost, it's never happened in modern history. It's never happened that the debt ceiling was not raised. There was a point in time when there was an argument between the Congress and whoever was in political in power that it was like a standoff where they weren't going to increase the debt ceiling, but they ultimately did that. And it feels like every time there's a new transition of presidency, there's always an argument around the debt ceiling. Forgive my ignorance. It could happen every year as far as I'm aware, but I'm fairly certain it only happens on the change of a president. Can you confirm or deny that, Tim?
Well, I will say this. I think historically that's been the case. I think just kind of what I see in the periphery, I think it's happening more and more often. Because it actually fairly certain it happened during an interim during Biden's administration.
That's right.
Um,
Yeah, I think it also happened. Yeah, that's right. It did. I remember that. So, okay. So, what could happen to the U.S. if we don't increase the debt ceiling and we default on our loans? We get downgraded our credit gets downgraded to the U.S. credit rating gets downgraded, much like a credit score for your personal finances. What that will ensue is it will create turbulence in the stock market, right? Because a lot of what companies depend on is international trade.
right,
And if we can't get money and they can't borrow any more money, that's going to impact their ability to do international trade. It's going to impact their ability to buy goods and manufacture them. And all of it is done on credit, right?
right.
It's crazy to think you would think it's all done on cash, which for those of you that don't know, the US was removed from the gold standard. I would consider that was, being everything done in cash, right? Because it was backed by something financial. Now it's just like paper, essentially just a piece of paper with a meaning behind it, right? So yeah, I mean, so if you have this turbulence in the stock market, what's going to happen? S&P is going to go down. The New York Stock Exchange is going to go down. Profitability of companies will go down. That could hypothetically send us into a recession if we're not already in one, which some people argue that we are. Some people argue that we aren't. However, you feel like taking that information, please do.
Yeah.
But ultimately, we cannot deny the fact that if we inhibit our ability to do international trade and manufacture goods and produce goods and things like that, yeah, debt makes the world go round. That is absolutely true. Profitabilities of companies will go down, investors' returns will go down, stock prices will go down. Everything, that is essentially, retraction in the market causing everything to kind of come back down in value. Now, a lot of people think stocks only go up. That's not true. Stocks also do go down.
Yeah.
I personally think that the stock market is overvalued as of today. But I have also thought that for the last year, and that's why I don't personally own any stocks at all. I would like to own some stocks, but I just don't feel comfortable investing into the market until there's a significant pullback since 2020, essentially, because there's got to be due for a market correction or cycle coming up here soon. And I'm not trying to time the market, but I am smart enough to know that when things are overbought, right, that they're overvalued, and that
Yep.
there has to be some kind of retraction coming.
Yeah. And guys, like for the history buffs out there, a lot of what happens with the U.S. credit rating is what incentivizes a lot of foreign entities to invest in the United States. We get a lot of foreign investment because of the stability of the dollar and the stability of our ability to pay and service our debts. For the history buffs out there, if you kind of want an idea of what happens when the U.S. is not stable, you can go back to about the 1870s, 1880s, when the U.S. was trying to come out of the Civil War and our credit rating sucked and our dollar was very unstable. We had a lot of issues getting foreign investment. In fact, the president at that time was working very, very hard on getting foreign investment in this country, and we were really struggling with it. So if you want to go see of like what a bad credit rating or the debt ceiling issue could incur, you don't have to go back 300 years to look at it. You go back about 150 years and you can kind of see what the U.S. could be dealing with here. But to Vitali's point, has it happened, right? Like, no, debt does make the world go round, but how far can you really raise the ceiling, right? Like, it's a ceiling for a reason, right? And, we, even on our personal level, I kind of made the joke about using credit cards to pay credit cards. Well, that can only happen for so long, right? You can only it's called kicking the can down the road is really what it is.
Right.
So, how far can you kick it? And then in modern times, if you kind of want to see on a much smaller scale, right, what can potentially happen to a country? I believe Greece earlier in this century, right, defaulted on its debts and its credit rating sank, and then Germany had to come in and bail them out. That's a good example. There's a good little example or study in like what happens to a country when it can't pay its debts.
The same is true with Argentina, correct?
Right.
I mean, that's
Right.
why it's made such historical news lately that I don't know if they call him president or prime minister or whatever they call the guy in Argentina, like the head guy, like what we call our president. It's the first time, I don't want to say it's the first time in a very long time that they are not insolvent, meaning they have liquidity and cash, and they are not operating at a deficit, and they were able to dig themselves out of a financial hole because
Yep.
of things that they have done. And now that's very surface level. That's about as much as I know about it. I haven't looked into it at all. But a lot of the reason why Argentina struggled was because they were not able to service their debts. Their credit rating tanked, their international trade went down. Corruption went through the roof. I mean, there's so many things that happen as a downstream impact of
Yeah.
not of downgrading your credit rating, your worldwide credit rating.
Yeah. So, but hey, Tim, what's that got to do with the price of tea in China, man? So
Right.
how's that impact us?
Right.
How's this all impact us?
So thanks. So what I wanted to kind of talk about was how does not increasing the debt ceiling impact
Yeah.
us as real estate investors? Well,
Right.
if you don't increase the debt ceiling and there's no more money to go around and we start losing profitability, what ultimately I think is going to happen there is going to make it more difficult for us as real estate investors to get debt to purchase property. Now, if you got a 30-year fixed mortgage on your single family house, you're good. You don't got to really worry about it. But if you are a commercial investor like Tim and I are, and you have expiring bridge loans, or you have loans that have 5-year terms or 7-year terms or 10-year terms on them, the next 24 months could get pretty painful if banks are not lending. Right? I mean, Tim Vest, you talk about it all the time. In 2008, 9, 10, 11, banks just were not lending. You could not get debt. That could potentially happen here as well if it doesn't happen. And all of these, I mean, something that's widely known is that there's been a lot of expiring bridge loans that were issued in 2020, 2021, 2022, and they've used extensions, but they ultimately the pipers come to get that money paid back, right? Because their loans coming due. A lot of syndicators, a lot of real estate investors in general are struggling to get new debt, refinance debt because of the expansion of cap rates, the reduction of NOI from increased property taxes and insurance, and they're struggling to be able to trade out their first position debt with new first position debt and put it on a fixed rate term. That could happen here. And why is that important for us as real estate investors? Well, because if you're prepared for it, then you see what could potentially be coming, and you're in a cash position, which Tim and I are now. We're ready to bounce on some really great deals. I mean, we've talked about it in the last couple of weeks how we've had some stuff come across our plate, and we're just like, nah, not a good enough deal for me to get out of bed. Where could you make money on it? Yeah, but do you have to make some aggressive assumptions and really kind of push the envelope?
Yep.
Yeah. And I'm just not in a position where I feel like I need to do that or I want to do that or I have to do that because based on all the information and the research and everything that's going on in the economy, we know that there are things coming. And being patient is very, very, very difficult. I know, Tim, you're chomping at the bit over there to do some acquisitions, but it has to be the right acquisition at this point, right? I mean, this is the point in time. Like, I like to relate this to like 2011, 2012, when people were able to buy stuff for pennies on the dollar, right? It's because they were patient, they waited, they were in the right position at the right time, and then they took action when something presented to themselves. We keep talking about all these expiring bridge loans that are coming due this year in 2025. It's only February. I mean, we just talked about it like 2 weeks ago. It's only February, and we still have looked at a number of deals that we've ultimately turned down because they're just not juicy enough to make it worth the risk. And I think that's the key part there is it has to be worth the risk with the unknown turmoil and turbulence that is expected in 2025. So, pay attention to the debt ceiling, pay attention to what's going on in the Twitter world and on the news channels and however you get your information. But pay attention to that debt ceiling because that could have an impact on you and your investors if you have them, based on what happens with the debt ceiling over the next couple of weeks.
Yeah, yeah. I mean, it's always something to keep an eye on. Now, this one, I got to be honest, this one will be a little interesting, right? Because this administration's going against the norm, right? I mean, in every which way, shape, or form, good and bad and indifferent. I- Who knows? Who knows what the game of chicken looks like this time? I don't know.
Who knows? I
Yeah,
mean, we've seen, plenty of chicken being played with tariffs with Canada and Mexico at this point. There's been, chatter with China. I mean, who really knows what's going to happen? I mean, it's still too early to tell.
yeah.
Um, yeah, it's still
Musk,
too early to
and
tell.
right, and Musk talking about, hey, like if we do this, we can pay off our debts, right? Like,
Well, yeah, that's a great discussion is about the whole Doge, all right? Department of Government Efficiency and how they're cutting out all this, the USAID contracts, and now they're looking at the IRS and the Treasury, and all of these things that they're identifying. Like I think this past week it came up that there are 20 million people receiving Social Security benefits that are debt. I think the statistic was there's 334 million people in Social Security are on Social Security, and or there's 334 million people in the United States, but there's 394 million people receiving Social Security benefits. I mean, I think I saw in there's like two people that were at the age of 360 years old or older. It was, either it's a data error or,
Right.
it's fraud, essentially. I mean, I don't know. Elon keeps saying it's fraud. Who knows, right, at this point? But the whole point of what they're doing to eliminate government waste is the only way to stop increasing the debt ceiling is to cut our deficit. And if we
Yeah.
can become a surplus where I think we're $36 trillion or $40 trillion in debt right now. Well, I think Elon's projection is that he will be able to get us to $1 trillion surplus per year. It's still going to take 40 years to dig yourself out of that $40 trillion hole, if that's true, right? I mean,
Yeah.
the magnitude, the gravitas of what that means is substantial, and nobody's really paid attention to it over the last 50 years because it really wasn't a problem. But now it's become a problem because the numbers have gotten so big. I think the interest now is larger, like the interest per year is larger than what we even make. So it hypothetically, if we continued at where we're at today in terms of spending, we would literally be impossible to buy ourselves out of the debt that we're currently in. Is that,
Yeah.
do you agree with all that? Did I say all
Yeah.
that correctly?
Do they still do that debt thing in Times
The
Square?
debt clock? Yeah.
Yeah.
So they do the debt clock, but now they added a Doge counter to it of how much money they have cut from, annual spending and how much money that's going to save the United States on an annual basis in order to help combat or slow down the ever increasing, debt counter.
Hey, by the way, just one thing, and the whole thing about the Social Security stuff that's flying around, 300 years old is a problem, right? But
I don't
guys,
even think Social Security's been around that long, so I don't even know how that happens.
yeah, but so that to me makes me think it's a data entry error.
I agree, but there's
Yeah,
I think it was like 30 trillion people or 30 million people are above the age of 100.
yeah. So, but just keep in mind, guys, there are legitimate reasons why people receive a Social Security benefit after death. Um,
Right, if it goes to the spouse or whatever.
That's right. There's survivor benefits. So and those can go on for quite some time.
Right.
So the
Correct.
only reason I say that is I'm not saying that data there's not something to that data. It's just don't take it on its surface because I've
Yeah,
seen it thrown out. I've
there's
seen it
way
thrown
more
out there
complexity
that this
to
is
it.
like definitive proof that something's happening. Right.
Right.
Like,
Well,
so
high level, it at least makes you question what's
sure.
going on, right? And shout out to my boss, Jen, if you're listening to this. I still use it today, but you just got to ask the question, right?
Right.
And we do that in our own business. Like I asked the
100%.
question to Tim, I asked the question to our VP and our new COO. I mean, I just asked the question because I don't want to make an assumption and
Right.
show it to me, prove it to me in data that this is correct. And if it's not correct, how do we fix it? Right?
Yeah. So
Somebody's got to ask the question.
Joe, to answer your question, Facebook, man, that's where I get all of my information.
He's posting from LinkedIn, so you should have said LinkedIn.
Yeah, but LinkedIn's too straight up, man. It's like actually what I do is I go to Facebook and Truth Social and I just read between the lines.
Do you
That's
use
what I do.
Truth Social? I
Not never been there once.
did your daughter use it?
No, my
No.
daughter on Truth Social. No,
Truths? Who likes those? TikTok reels.
What the hell's truth these days?
I use Twitter, whatever you want to call it. Obviously that's why a lot of information is skewed towards, Elon's perspective, because that just continues to show up in my newsfeed. So look, I acknowledge it right at the end of the day, but that's kind of where I'm getting my information from. So, okay. All right. Moving on to the second part of this show before we get too deep into this is what is the, so the debt ceiling potentially doesn't get raised. Loans go into default. People aren't able to refinance. Banks take the properties back. Property values start to plummet. Cap rates expand, right, or decompress, so that values go down. What that does for the overall market is it creates a great buying opportunity for us as real estate investors. And how does that impact inflation? Well, historically, inflation causes things to go up. I mean, that's exactly what it is, right? So being able to position yourself with the ability to buy a discounted asset because the bank took it back, it's in foreclosure or something like that, and put it into long-term 5-year debt, 10-year debt, something like that, and capitalize on today's dollar, so that with the pending inflationary period that could potentially come up again, with rents continuing to go up and construction costs going up and taxes are going up and the insurance is going up, you're still borrowing money from 5 or 10 years ago because you locked in that fixed rate debt. Um, a lot of people should pay attention to how they're diversifying their assets, whether it's, in the stock market. Obviously, there's warning signs, or people have continued to put warning signs in the stock market about it being overvalued and, a recession coming in. I think that this could be the trigger event. If the debt ceiling is not raised, this could be the trigger event for stock market. I don't want to use the word crash, but we'll call it a retraction. Things come back down in value. I hate the crash. I mean, that's too much of a clickbaity word, crash. Oh, it's going to crash. That's kind of like
Well, and I
the
mean,
sheep that cried wolf.
well, and my question is always like, are we truly talking about a crash? And to your point, it's like most people are really talking about a retraction. They're talking about a pullback in prices, right?
Correct.
You crash, guys, 1920s is when a crash happened. Like,
Yes, correct.
that's a crash.
Right. But yeah, so the inflation, I mean, is causing construction costs to go up. I mean, I know that, they went up drastically during COVID. We saw some construction costs go down recently, like the last 12 months or so. I don't know if they've gone down a whole lot, but at least they've stabilized. But so one thing that I don't think people pay attention to enough is the cost of construction. And what they don't realize is your replacement cost continues to go up. I think the replacement cost on a property now is like, I don't think you could build an apartment complex for less than $150,000 a unit, right? And maybe somewhere between $125,000, $150,000 a unit, probably your cost.
No,
right?
no, I don't think you can.
Right. So, if you're buying things below replacement cost, you're in a pretty good spot, right? But what people don't pay attention to is as the market cost continues to go up, the insurance prices will follow because
Right.
the cost to replace your building in terms of insurance continues to rise. We've already seen astronomical increases in insurance. Those astronomical increases are just keeping up with the cost of construction and inflation, so that the replacement cost on your building, when you actually have a fire, that you can tear it down and rebuild it with exactly what you had and not have any money out of pocket. That continues to get more expensive, therefore causes your insurance policy to get more expensive. So I don't see any relief coming in the insurance market. I actually see the insurance market continuing to get worse and more difficult because of potential inflation and increased construction costs, right? What does that do, Tim? That reduces your NOI, and then you're also in potentially a market where your cap rate is decompressing. You see how these things really start to compound on your underwriting and the valuations and your exit strategies of the properties that you own, because now your insurance is up, your NOI is down, your cap rate's decompressed, your DSCR has been increased from 1.2 to 1.3. Interest rates are not 2% anymore, they're 6-7%. All of those things are negative headwinds when you go to try to sell a property or refinance it.
Yeah. Yeah. Hey, but that's a whole bunch of bad. That's a whole bunch of
That's
bad.
bad. Yeah. But
So
but it's difficult, right? Because 2025, the end of 2024 and 2025 thus far has been difficult for us because of insurance, because of refinancing, because of bridge loans. Thankfully, we bought them at a good basis. Thankfully, that we were able to execute on a business plan. Unfortunately, a lot of investors are unhappy because we're not making distributions, but we're also not losing money like a lot of other people are.
yeah, Tim's sitting on a sore point. We actually have crafted some pretty lengthy responses recently about that kind of stuff. And
Right.
and guys, like, listen, it's exactly what we're talking about right here. Like, I crafted one over the weekend, and it was basically, hey, listen, there's a lot of things outside of our control here, like taxes, insurance, construction costs. Hey, guess what else happening with construction costs, right? Like the Southeast saw significant hurricane issues this past year. LA, have you checked what's going on in LA? Hey, all of that needs to be rebuilt. And guess what that's going to do on our supply, right? It's going to put bigger demand on supply. Inflation's going up, guys.
Yeah.
You know, and then,
Inflation's go up, and supply and demand, right?
right. So, all of those things factoring in tariffs, all that good stuff, like, I mean, these are all long-term plays that we're talking about. So you need to take a long-term view. And I guess where I'm going with that is like, hey, are you still buying by any chance? Like all these bad things that we're talking about, are you still buying?
So look, I mean, this is the prime opportunity to buy stuff. Like I'm genuinely excited. though I know it's causing me to lose my hairline a little bit because it's stressful as shit. But 2 to 3 years from now, when hopefully all of this subsides,
Yeah.
the supply and demand comes back into equilibrium because we know there's been no new construction starts in the area, right? So we know that supply, yeah, thumb up, yeah. So we know the supply, we're going to have a constraint on supply. Well, we own the supply, right? So we're in a good spot when you own the supply, not when you need to buy it, right? So now we have assets. We'll put them on long-term fixed rate debt. Inflation will cause the rents to continue to go up as supply and demand equilibrium equals out. Then the demand starts to climb. The rent rates will continue to go up. The
Yep.
only way to kind of dig yourself out of this hole of taxes and insurance and decompressed property values is to wait. You have to
Yes.
wait for the rents to keep up with all the changes in expenses. They don't happen in a linear fashion. They're
Yeah.
usually it's one goes and then the other and then this goes and then they all kind of move whenever they need to move. But the best thing that you can do for yourself as a real estate investor is buy yourself time, because the more time you have, real estate is and always will be at its core a long-term investment strategy.
Yeah.
Now,
So
myself is guilty and other people are guilty of it, like, creating quick wins and being able to, turn properties pretty quickly and sell them for profit and make money. Like, yeah, that's addicting. Like, it feels good, but it is never the primary business plan. The default fallback plan with a commercial real estate asset like apartments that we do is to own it for 5 to 7 years. And within that time period, we're going to be okay.
yeah, and for you guys out there looking for like that kind of stuff, because what Vitali's talking about, like, this is a really good spot to be putting your money to protect it against inflation, right? Like as inflation goes up, multifamily, self-storage, you name it, those things tend to increase with inflation or even outpace inflation sometimes in terms of value. So it's a good place to kind of protect your money. Now your money's going to be locked up, but it's protected, right? And the only other thing I would say to that is like, just make sure you're going out there and you're getting invested with and you're getting partnered with folks who have the same viewpoint, right? That's like, hey, we need to protect this asset. That means keep cash flow, cash reserves strong, right? Like keep these things well positioned to weather whatever's coming over the next 12 to 18 months. So guys, go find investors who think, or operators who think that way, who aren't, bleeding it for fees and who aren't, just making sure that they're kind of taking care of themselves. Go find operators who have that long-term view and who have pretty much said like, hey, we're in this together and we're going to keep reserves strong. And that's our primary goal. Right.
Yeah. Yeah. Choose your hard. Yeah, investors get upset when you're not making a distribution, but I guarantee you they will get more upset if you have to do a capital call or you tell
Right.
them, "Hey, sorry, we lost all your money." Why? Well, because we chose to do distributions with the money that we had in the account rather than keep it in the account to weather any
Yeah.
coming storms. And the
Yeah.
biggest thing that we've had to hold money back into reserves for is for the insurance renewals, because
Yeah.
sure, we budgeted and we're accruing expenses to make sure that we can pay the insurance, but what happens when your insurance policy goes from $60,000 to $100,000 on the renewal and you only got $60,000 that you put away, or maybe $65,000, because you assumed it went up, 10% would have been $6,000, right? So say you got $66,000 in reserves and you still need to come up with another 34,000. That's
Yeah.
that's the hard conversation to have, and people can't see the trees from the forest because they only want to think about their distributions on a quarterly basis. Now,
10,
I know that that might seem like complaining, but that's the truth of the matter, and we have to make those hard decisions and tell people, "Hey, you know what? This is for the betterment of the property and your investment in your money as a whole."
yeah, dude, you just blew some people's minds. You were like 10%. Like, I don't even budget 10% for an insurance increase.
Right.
Most
And
guys
we
put
saw
that 3 or 4.
100% increases. Yeah.
Yeah, most people put that 3 or 4%, slug on there, and that's it. So
Right.
yeah,
I mean, it's hard no matter what, but choose your hard, right? Whether you're going to buy deals when the market's hot and you can't find good deals and you got to stretch things, or you choose to buy your deals when everything is very difficult, insurance, debt, investors, all of it's difficult. That's your key sign right there. Hey, I need to go out and buy more stuff because this is the opportune time to get pricing at a discount to position myself for future success. I guarantee you 5 years from now, Tim and Tim are going to be like, damn, this was the best thing we ever did.
yeah. Just hey, you got to delay gratification a little bit, right?
Yeah, I
Um,
agree. So,
so
all right. Well, this has been super fun. I really enjoyed this. I like these complex topics. I like how they apply to our political environment as we know today. How this episode will age, I don't know. Hopefully, we can use this one as a show in the future and kind of look back at it and say, well, these are the things that we talked about, whether they become true or not. But
Yeah.
ultimately, at the end of the day, we hope that you learned something from this. We hope that you got a little bit of insight to how we operate and why we make the decisions that we do. Sometimes the less popular decision, more often than not, the less popular decision is the right decision to make.
Right.
So we deal with that as it comes, and we try to protect our investors and our investments the best we can. So,
Yep.
all right, with
All
that,
right, guys.
appreciate it. We'll see you next week.
All right.
Peace.
Take care, folks.